And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, the Hump Day edition of The Real Investment Show. It is, of course, Wednesday already. This week has gone by really fast. I just, got back from vacation last week. It's already Wednesday. Disaster at my house yesterday, so it's been just an absolute kind of whirlwind for the last couple of days to get back in the saddle, but it's all good. So we're starting to get into the end of this week, and as we get into next week, of course, that's where we will kick off earnings Thursday and Friday. Big banks, there'll be JP Morgan, etc. So kind of all eyes are starting to really kind of set up for earnings season to kick off. Right now, just economically, there's not been a tremendous amount of data flooding in. Now, we're going to get CPI, PPI coming up next week. So we're going to have some more data to work with. Not a lot of economic data today. The real kind of story at the moment just continues to be tariffs, where Trump has threatened a 200% tariff on pharmas. But interestingly enough, pharmaceuticals are actually trading up in pre-market this morning. So again, there doesn't seem to be a whole lot of fear that the threat of a 200% tariff will actually come to fruition. And this is, kind of, we talked a little bit about yesterday, and I did an interview for Bloomberg yesterday as well, talking about these tariffs, is that, we're kind of back to that, kind of the whole threat, pre-Liberation Day. In April, markets were doing okay, and we were having all these threats about tariffs. And then, of course, Liberation Day comes, and he holds up the board with these onerous tariffs on it. The market completely kind of crumbles. We're kind of in that same saddle, but now markets are looking through that, going, yeah, we kind of know this story. We know that he's going to threaten these things, but at the end of the day, it's just the stick to try to get a deal done, and then these will go away. And so markets aren't really paying as much attention to tariff threats this time around. But President Trump is saying that come August the 1st, if there's no deals done, then tariffs can be put back on. So there's risk. The point is there's some risk to the markets right now, particularly with markets being as extended as they are. We've had a big run here. We've had a 25% advance from the lows. It's a very big advance. We're very deviated from means. We'll talk about kind of the technicals here in a few minutes. But there is some downside risk here. And over the last couple of days, yeah, we've had a little bit of sloppy trading over the last 2 days, but nothing really to any degree to say, hey, we've had a pullback here. So there's just, as we talked about the last couple of days, there's just some risk, kind of sitting in the markets right now, even though sentiment-wise, investors are, kind of just shrugging off all the news at this point. And there's kind of the other big kind of driver here, I think worth paying attention to, at least as we go forward over the next couple of months, is there's a pretty big gap right now between equity market performance and kind of macroeconomic data. And those are diverging pretty sharply right now. We're definitely seeing some weakness in the macroeconomic data, but the markets are just continuing to kind of rally higher here. Now, that doesn't, that's not the end of the world, but the market is a reflection of economic activity, because economic activity, as we've talked about before, is where earnings come from. And there's a very, very high correlation between the year-over-year rate of change in markets versus personal consumption expenditures, as an example, because that's where the earnings growth comes from. So right now, analysts are really expecting, a little bit of weakness in this kind of second quarter earnings. Still positive, but they've cut revisions down for this. So, but a little bit softer revenue, economic earnings growth in the second quarter, and then a big surge going in the last half of the year. But the macroeconomic data is suggesting slower economic growth into the end of the year. So they both can't be right, and so there's some definite risk here worth paying attention to. Now, none of this means the markets are going to crash and just completely destroy themselves, etc. So I'm not laying out the bear case, that, this is, you got to get it out of the markets, go hide and cash. I'm not saying that at all, but I am saying there is a big enough divergence now between some of the economic data in the markets that suggest, A, one, that upside may be somewhat limited, but B, there is some downside risk. And it's at least worth paying attention to, as you kind of manage the markets and navigate the markets in your portfolio. So here's what you need to know before the bell this morning. So just kind of following through with that same analysis of kind of market risk that's developing momentarily. We talked a little bit yesterday. We've got this big divergence between the markets and moving averages. Those tend to resolve themselves to the downside. Generally, get a bit of a correction, and moving averages tend to be moving up over time, so they kind of meet in the middle. But there is some risk down to about 6,000 right now on the index. Now, it doesn't sound like a lot considering where we've been, but we're around 6,200. So you got a couple hundred points of downside risk in the markets, right now. So it's at least worth paying attention to. And that would just and all that would do would just bring you back to this kind of this breakout that we did to all-time highs previously. So again, not a lot of downside risk here, but definitely some, and that would help reset some of this overbought condition we've got in the markets. Relative strength is very overbought right now. The MACD momentum indicator, that's also elevated. So again, a bit of a correction here wouldn't be surprising. Now, again, markets are trading a little bit flat this morning. We'll see how markets kind of come out of the gate and kind of see what the action is. We did see a little bit of selling pressure yesterday, but then we saw a short covering rally kind of the afternoon that kind of salvaged the market a bit. But again, the markets are just kind of trying to hold in at this point, kind of heading into earnings season. But again, it's just, again, volume's been lightening up here a bit. We're starting to see a kind of a reduction in flows into the markets in terms of money flows. So just things, again, just kind of shows a weakening of momentum, a weakening of that price action that certainly kind of gives you a warning sign that you just might want to be a little bit cautious here, about chasing stocks or chasing markets at these levels. Kind of looking, we touched on the VIX yesterday just momentarily in our conversation, but the volatility index has dropped back down to 16. We're at a very low level on the volatility index. Volatility, of course, is just a function of options trading, and all this really means right now is that nobody's hedging for any type of downside in the market. There is no, kind of risk control in portfolios. Nobody's buying puts, even though they're very, very cheap right now. You can hedge your portfolio for very little bit of money, but nobody's even willing to do it because they're worried about missing the upside. They're not even willing to expend the capital for insurance because of really rather just kind of chase the upside markets. And that's always a little bit of a dangerous situation when that happens, because that's just that sentiment kind of getting off sides. And we're definitely seeing that in both sentiment indicators as well as positioning in markets. Technical indicators are stretched. So all that's kind of setting up that you're going to get some type of correction. Now, here's the trick to all this, though, is that correction can be a week from now, 2 weeks from now, a month from now. These conditions can stay this way for quite some time. So you've got to be real careful about just saying, oh, well, Lance said the markets are going to correct, so I'm going to go sell everything. Don't do that. I'm just saying that you've got all the ingredients right for a correction, but you need some catalyst to actually to get buyers out of the markets and bring sellers back in. You need some catalyst to do that. It'll be a headline event. It'll be some economic issue, whatever it is. But something will come along that'll trigger that selling. But that could be a week or 2 or 3 or 4 from now. But again, this is why I'm just saying you want to be a little bit cautious here about chasing risk and kind of go look at your portfolio and see, kind of how much risk you've got laid out in your portfolio, how much you've got layered into, leverage bets, those type of things. They've been working great right now, and so you're making money. Don't forget to take some profits. And, the one thing, and that doesn't mean sell everything. It just means reduce that position a bit, put a little bit of cash on the books, because you're going to get an opportunity here to put that cash back to work at a better level. So again, just kind of monitor where we are right now. Again, I'm just starting to see a lot more signs of risk building into the markets. It's nothing catastrophic, but it's certainly suggestive that you're going to get some type of corrective action here soon. That's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff. We're going to talk a little bit about how to inflation-proof your retirement today, so don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me this morning. How are you, sir?
Hey, good morning. Doing great.
Good. Got your suit on every day?
Every day?
Well, got your suit on today is what I meant to say.
Every day today.
But every day today.
Sometimes.
You got meetings today?
I do. I do.
I'm dressed up, spiffy.
Yeah. Trying to set the trend around here, Lance.
I know.
I'm not saying anything.
I know. The only reason I wear the same shirt every day is so that when Brett cuts it in when I'm not here, you don't know that it's not live.
I think we all know. I mean, that's the problem with what you do on a day-to-day basis, right? It's not evergreen. It's something that's new every single day.
I know.
You're talking about markets.
But we do have evergreen stuff, and every now and then we'll post some evergreen content up on our site. But again, if I'm wearing a different shirt every day, you'll know that it's not that same day. So anyway.
Well, thank you for thinking of Brent's well-being.
Exactly. Brent needs, after yesterday, Brent needs it.
Yeah, so, rough day?
Monday was worse, too.
Well, that's always the way coming back, right?
I was making fun of him yesterday. So anyway, a couple of things to get into this morning. So again, one of the big questions is, a lot of concern about inflation, kind of going forward. And again, look, inflation is always a thing, right? Prices go up over time. And this is kind of one thing that's interesting to me about people's view of the dollar is a good example. It's like, well, the dollar keeps losing its value. No, it's not. It's just that it's, you're combating rising prices over time. So, the dollar is the dollar. I mean, it's $1. And so, yes, it's adjusting for inflation over time. But, again, that's just a function of economic activity, the growth in the economy, more population, which gives you more supply and demand, which creates higher prices. And so inflation is going to be a function that grows over time. Again, if you have no inflation growth, you have no economic growth, and that is even worse. So, this is kind of the thing that, kind of eludes a lot of individuals when they talk about inflation is like, oh my gosh, prices are going up. Yeah, I know prices are going up. I get it. But if you have no inflation, you have no economic growth, and that's actually a worse thing. Right. So inflation is not a bad thing. Now, you don't want skyrocketing inflation, right? You don't want 9% inflation caused by, an economic shutdown and sending checks to households. You don't want that, right? You don't want inflation shocks. Those aren't good economically. But you do want a slow pace of inflation growth over time, at least one that is in line with economic activity, to make sure the economy is growing so that your wealth goes up, you make more money at work, those type of things. So it's just a function of that works. But we do have to deal with that inflation problem. And, for a lot of individuals moving into retirement, it's like, okay, great. I'm finally going to, hang up my, my work gloves, and I'm going to retire. And I've got this nest egg, and I've got to make sure this nest egg is going to last all the way through retirement. And unfortunately, because of the miracles of modern medicine, we're living way longer than God intended. So, yeah.
And facing many more healthcare issues and other problems that maybe we hadn't seen as frequently previously. But, one thing when we talk about inflation is, number one, like you mentioned, inflation is not all bad. We want inflation. We want economic growth. Now, with inflation, we also want wage growth. And unfortunately, that doesn't always go hand in hand. But in a booming economy, historically, it does.
Sure.
We do see that. But when we look at financial plans, we're actually assuming that our clients are giving themselves a raise each and every year. And I've never had somebody do that, ever. Been doing this over 20 years, never had a client give themselves a raise each and every year.
I know.
Now, what happens over time is that we'll review financial plans, and, inevitably at some point, usually we see like 3 to 5 years, somebody says, hey, you know what? I feel like we're living on, we're eating ramen noodles the last week of every month. What can we do? Can we take a little bit more out? And almost every single time the answer is yes. We just haven't done that on on January 1st, people don't call and say, hey, let's go ahead and give me that 3% raise or 2.5% raise. It is over time. But what we also find a lot of times when we do see inflation ticking up, or like when we saw in 2021, 2022, you just alluded to that. Mm-hmm. People inevitably begin to spend less, or as you've mentioned a lot of times, they defer spending money on certain items. Now, some of these things are obviously, eggs and other areas that we're going to probably buy on a regular basis. That's going to be inflation that's going to be repetitive.
Yep.
But a lot of that other stuff isn't. And it's a function of kind of the economy and everything else. We're probably a lot better at pulling back and saying, making educated decisions on things we want to buy or have to buy than what I think most studies show or allude.
Yeah, no, I agree with that. And this is one of the things that, when, specifically talking about now I've retired, I've got this, kind of nest egg of money. And it's interesting too, because one of the things that, we talk about a lot is, having a cash cushion sitting somewhere, right? Mm-hmm. Having this emergency fund. Because, the one thing we don't want to do in retirement is take withdrawals out of your retirement money during a market downturn, right? So, if you need a 4 or 5% withdrawal rate, you want to try to avoid, accelerating the decline in the market because asset prices are going down. You'll accelerate that decline by drawing out of the capital in your investment account during a retirement. So if you have another pool of money just sitting on the side, just a cash cushion, you can utilize that cash during a market downturn so that you don't exacerbate the decline in equity values. So that when they start to recover and grow back, then they start to put you back on the right path. So there's some things to look at, importantly, in terms of managing, because you've got to stretch this pool of money for a very long time. Your retirement may be decades. Yep. You may retire at 65 and live till 95, right? So you've got 30 years that you've got to stretch this pool of money over. And again, then you've got, like you said, you've got increased healthcare costs. Because you're going to have more medical issues as you get older, unfortunately. It's just part of the process. So we've got to kind of factor in all this. And so there's some kind of things like Danny was saying is you've got to factor all these things into the plan, but then you've got to make sure and this is one of the mistakes that I see a lot. Individuals are too conservative in their kind of their portfolio structure as well. Going, I get it, right? I can't afford to lose money because I'm not working anymore, but that can also really work against you as well.
It's interesting. I think because of the day and age of so much information and we get it so fast, people are so concerned about a large drop, right? That Black Swan event that we always talk about. And granted, there's a lot of people talking about that, but they've been talking about it for years. And how often does that actually happen? And do you have a portfolio that will actually sustain you through that time? And it doesn't have to be a buy and hold strategy, right? That's usually what most people are talking about. But you can be nimble. You can utilize some of these things to your advantage. And I see, unfortunately, a lot of people who say, you know what, I just can't do it because I can't take a 50% drop. Well, have you taken a 50% drop? What are you currently allocated like? How much do you have in equities at the moment? That usually is the big question. And what we find, though, we're talking about inflation here, is that people will get so conservative. You're not keeping up with inflation, right? If we're only in fixed income, what is fixed income designed to do? It's, whatever that rate you're receiving is likely what inflation is at the time. And if it increases, well, you're going to lag, right? And inflation is transitory. We do know this.
Mm-hmm.
And
yeah, and again, but the big thing is that interest payment never changes.
Correct.
Yeah.
Which is great, but it also doesn't keep up to inflation if we do see higher inflation over time and you see that compounded year over year over year. And so that's where like an old pension, right? Pensions are great. We absolutely love them. They're dinosaurs. They're almost extinct, right? You don't see them very often. However, most people with pensions, they have another set of guaranteed income along with Social Security or another type of retirement plan. And that is really beneficial when we think about, long-term planning, because a lot of times that can meet a lot of people's expenses, and everything else you've done, all the savings, is icing on the cake. But the one problem with that is that pension may be great today, but when you're 80, 90, inflation's eroded a lot of that, what it is, right? Your purchasing power is declined. And so we have to find other avenues that can keep up with it. And you tell people this often, I hear you say this, is, what is the goal of equities in general?
Right. It's to adjust for inflation.
Yeah, adjust for inflation. You want to get a little bit more if you can. That's fantastic. But at the end of the day, I think that we're so hypersensitive to declines, and I get it. Trust me, this is what we do for a living. We understand this is your livelihood. It's your security. It's something you've worked for your whole life. However, you're going to have some type of exposure if we want to have this from an inflation perspective. And then what is the goal? Are we looking to never erode any of the principal that you have? I mean, year to year, that's going to be a challenge. You're going to have good years, bad years. Markets are not, they're fairly dynamic if you don't know. I mean, that's why Lance talks about this every day. And it's not a static type of portfolio in general. Now, you can find those. Go buy an annuity if that's what you need. You say, look, I don't ever want to worry about it, and I want to collect X amount on it every single year. That could be a great tool for you. But most people are going to need something that's going to help them keep up with that inflation push.
Yeah, and I want to talk about that when we come back from the break, because you made two comments. One was talking about the 2008 financial crisis, right? Just, this 50% decline. And that's a really interesting concept, because what we've seen since 2008, and we talked about this before, is that the number of people that we run into that have been mentally scarred because they went through it.
Yeah.
Right? And then there's this whole group of investors that have never seen a real bear market.
Who don't care. And they're probably the ones that are benefiting the most from this right now, right?
Exactly. But they've never seen the devastation.
Yeah.
But there's an interesting byline to that. We'll come back and we'll talk about that after the break, because it's a function of time. And we'll talk about kind of past history here just real quick. But I want to relate this back to building your portfolio to inflation-proof your retirement. So don't go away. Coming right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I remember in school those history stories about the late 1800s, and now Gen Z kids are now calling the 90s the late 1900s.
The Real Investment Show podcast.
And I feel like I just drank from the wrong grail in Indiana Jones.
Same show, your schedule.
I was talking to my daughter a few weeks ago, and I said something that she didn't agree with. And she goes, "Dad, you're just getting old and not relevant anymore."
At realinvestmentadvice.com.
Not relevant.
You're not relevant.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So I wanted to pick up on a comment that Danny made because I hadn't really thought about this before, Danny, until you made that comment. And then it just kind of, I got this. This is how I test myself for dementia, if I can remember stuff. So I don't have dementia yet because I can still remember some stuff.
Well, that's good.
I just don't remember who this guy is. The guy running the board. His name. Whatchamacallit. Yeah. I am the world's worst with names.
Y'all been working together for like 25 years, though. That's ridiculous.
Yeah,
Lance.
but I remember people's faces, but I'm terrible with names. Are you like that? I mean, and people come up to me all the time. Like my wife and I were having lunch at Jason's Deli on Monday, and a gentleman walked up, Joe Strong, and if you're watching the show this morning, it was nice to meet you. But he walks up, introduces himself, and starts talking to me and my wife. Says, "Oh, I listen to the show all the time. It's great, blah, blah, blah." And then, he left, and my wife goes, "Who was that?" I said, "I have no idea."
She's like, "He just told you his name."
No. I mean, I knew his name, but I'd never met Joe before. But, now I've met Joe. But that happens a lot. And, and then I'll run into him again. And I was, "Oh, it's so nice to see you." But I cannot remember your name for my life. And I'm sorry. It's just, I remember your face. I know exactly who you are. I cannot remember names. I'm just terrible with names.
It's an occupational hazard because you know so many people.
Yeah.
I have the same problem because of all the people that I deal with.
Yeah.
You've got the context at work. I've got a context at church. when I was going to school, I had that context, and I'd see people in the store. I know you, but where do I know you from?
Yeah, I love when my wife is with me because I'll go, oh, so yeah, great to see you. This is my wife, Christina, and then my wife will introduce herself, and then the name will come out, and I'm like, yeah, it's John, yeah.
Hey, Brent, you want to fix that real quick though? Just don't show up and don't call one morning. He'll remember your name real quick.
Exactly.
No, I like my paycheck.
No, I don't.
So anyway, but I'm really good at remembering like facts and figures and dates and mathematical stuff, right?
You're scary good about that.
Yeah. So, but I can't remember where my wife put the ketchup. I always have to ask her where's the ketchup.
Well, we can debate on some of those dates and names. I mean,
yeah, well, just only when it comes to you.
Hurricane Carla, and if
well, no, that's show material.
I know.
Yeah,
just like I
was alive during the Depression, so
correct.
Just to remind you that
we know.
But I was alive during the 1987 crash, and I was alive during 1974.
Yeah.
So. Yeah. The crash in 74. Here's the point I wanted to bring up. So Danny brought up this context about this. A lot of people are worried about another 50% correction. And if you're worried about a 50% correction in the market, it probably means that you lived through the financial crisis in 2008. And so you saw what the devastation was financially, economically, et cetera. And you certainly don't want to go through it again. It was a very painful, period of time for a lot of investors. Now, there's a lot of investors in the markets today that have never seen that. They started, they became of age of investing after 2008, and it's hard to believe that was, that long ago now, but there's a lot of investors in the market today that have actually never been through a real bear market. The pandemic was not a real bear market. It was 35% decline, yes, but it never broke the bullish trend and immediately recovered. So it was just a correction. It wasn't a bear market. But 50% corrections is like, oh my gosh, those are really scary things. But I remember coming out of the dot-com crash, and before 2008 occurred, there were a lot of people that would not get back into the markets because they were worried about another 50% correction that they witnessed or experienced during the downturn, during the dot-com crash. The same thing was true prior to 2000, where a lot of people that I would run into and deal with in managing money were either worried about another 1987 type crash, or they were worried about another 74 type crash because they had lived through that. And they were worried about that type of, again, I was like, here's this dot-com bubble going crazy. Markets are just accelerating. And they were still anchored to this kind of anomalous event that occurred in 87 due to portfolio insurance, or 1974. And, but that's the nature of human beings, is that we anchor to these events, but start thinking about the time frames between these, right? 1974, 1987, 1999, 2000, 2008. This is 2025. So you've had 4 big events over the span of basically 40 years. And, so they don't happen often. They happen about once a decade or so. So we've got to understand that these big events, they do occur, but they don't occur out of nowhere. It's like you're not going to go to bed one night and then wake up the next morning and the market's down 50%, right? That's not going to happen. You're going to go to bed one night and you're going to wake up and go, man, the market's really been struggling here lately. We're down 10, 15% from the peak. Markets are really struggling. There's all these other things that are developing in the markets. Market downturns like a financial crisis or a dot-com crash, they don't occur overnight. They give you plenty of warning, and they also give you plenty of opportunity to rebalance your portfolio during that decline to help mitigate that risk. And so, it's important psychologically to try to remember how these things occur. We're anchored to the event, and we remember that event being very painful, but we also want to remember how they occurred. We want to remember the sequence of events. 2008 is a good example. Bear Stearns blew up in March. Then the markets rallied back to all-time highs. Then they started deteriorating in the summer, gave you plenty of warning that something was falling apart, in the mortgage
market. It was the end of
summer,
beginning of fall when it really started.
Well, it was still coming down. In June, July, we broke the head and shoulders pattern technically in the market, big warning sign. We had deterioration in momentum, big warning sign. And then, September the 18th, Lehman files for bankruptcy, and then 40% of the entire decline occurred between Lehman and the end of the year.
Yeah.
So, but you had warning, right? You didn't have to wait until you woke up one morning and the Lehman Brothers bankruptcy is in place and they're shutting down the markets and you're going, now what do I do? You had plenty of warning ahead of time.
But even then, how many of you out there were actually fully allocated 100% to equities? Were you just in the benchmark? Were you more aggressive? And so I think that's one thing that a lot of people fail to recognize is that, okay, wait, the market was down X. What were you down? And here's the other thing. How does it impact you? Can you still meet your goals, your objectives, all the things that you want to accomplish? Now, yeah, is it a setback? Absolutely. Should you be planning for something in your financial plan? Absolutely. But there's also been, Lance, I mean, you think about COVID, we had a rapid decline in, February, March of 2020. Markets are down, 35, 36%, and a very quick recovery. I mean, cycles have changed. They've been much quicker. And, I think we've talked about, how does that change at some point? But we've also had in 22, we had the worst year in bonds you've seen since 1788. You saw the S&P down 18, the NASDAQ down 31, 32. And, here yet we are. And so all these narratives that we want to place on the markets, and I think the big change is that previously we got our information from the newspaper, like physical newspaper. When I started, and you've been doing this a lot longer than I had clients that were coming in that were, they had these graph sheets and they would literally, that's how they tracked the market and the stocks. And they would look at them, by looking at the paper on Saturday or Sunday. And that's what they would spend several hours doing, and that's how they'd get their information. Whereas now, I mean, it's a click of a button. It's on every news outlet. There's so much that's inundating us, and the bears are prevalent.
Yep.
Right? I mean, what sells? Fear sells. And so we have talked often about, if you turn on the television and everything's great, or you look on, CNBC, Fox Business, whatever it is, what are you going to do? You're going to spend time with family, friends, hobbies, things you enjoy. But if all of a sudden things don't look so great, we're going to be glued to it because it's our financial livelihood. It's a security blanket. But we have to take a step back. How do they get paid? Do they get paid for you clicking on their ads? Yes. I mean, you may not be paying them, but every time you do, their ad revenue starts to increase. So we have to remember that we're much more inclined to look at the bad stuff, which is why, even most local news seems like it's all doom and gloom.
Yeah, no, it's true. If it bleeds, it leads, right? So I want to flip this back to inflation proofing your retirement, and so one of the things to inflation proof your retirement, of course, is to avoid big psychological decisions, worrying about events. And again, there was a comment in chat that says, "Hey, we're due for another crash." We are due for one, right? If you think about the time frames, valuations, those type of things, but probably it'll be in the 2030s, right? Early 2030s, but predicting that far out is a fool's game. You can't really do that. But we certainly do have dynamics set up. We talked about retail speculation. We've talked about, kind of extremely low volatility risk in the markets, et cetera. So there's a lot of stuff building up in the markets that could certainly lead to a much bigger correction. But you're going to need some type of event, a recession of some magnitude, a financial event to trigger that type of a downturn. So again, not anything you need to worry about today, right now. But when you start thinking about inflation proofing your portfolio, the one thing is to make sure that, and again, this is what Danny alluded to earlier, is to make sure that you aren't too conservative with your allocation. And we've talked about building a portfolio previously. I want to go back through that right after the break. But being overly conservative, and this is the big challenge that we have with a lot of older investors that come in, for
and younger,
money, and younger, even that's true. They're too conservative, and that may be hard to grasp. Is like, how can I be too conservative with my money? You can be so conservative with your money that you actually begin to impair the survivability of your portfolio over long periods of time. And so we'll talk about that when we come back.
And
to
you
the
can
break.
be too aggressive as well. But yeah.
Well, of course.
Yeah.
There's extremes. I mean, like wearing a suit to a radio show. It's kind of extreme. Come back after the show.
Lance.
I have to come back after the break and I'll go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and Market Watch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, so we've talked about before that building a portfolio is important, and there's, again, just keeping things very simple right now, just for the sake of conversation here. You can add in all other kinds of assets. You can add in gold, you can add in commodities, you can add in, but I just want to keep things very simple right now, just for the sake of conversation, because, just to make a point, as we've talked about before, dividing a portfolio. You have your fixed income side, which delivers a straight rate of return, right? So I buy 4% Treasury bonds. I'm going to get 4% every year. But that coupon never adjusts for inflation. So if I have a $1 million portfolio and I split it in half, I put $500,000 into Treasury bonds, I'm going to get 4% every year on $500,000 for the term of those bonds. And that income is never going to adjust for inflation. And so this is why, it's important to have the equity exposure, which will grow with markets over time and provide a dividend yield. So that increases your income flow for right now. But the other 50% of my portfolio is growing with the markets, which as the markets grow, that 50% of the portfolio becomes 60% of the portfolio. So I rebalance it. I take it back to 50-50 and I add that 10% over to my bond side, which increases my income. And that's helping the income adjust for inflation over time. The problem that I run into a lot, with our advisors who are, dealing with prospects or clients, is they're so concerned about a market crash. They're like, I want to be super concerned. I want to be 100% bonds. It sounds okay when you say, I can put all my money at 4%. And I'm fine, because we hear about the 4% withdrawal rate, and I can just make 4% on my money right now. I'm fine. The problem is you're going to run into the inflation problem over time. That 4% is not going to be 4% next year. It's not going to be 4% the year after that, because the actual cost of living is rising because of inflation. So we have to adjust. You have to have equity exposure to some degree to adjust for that inflation run over time.
The problem though is I've met very, very few people that can actually do that, Because what happens, the market begins to run. They think, oh my gosh, I need to be out of this. I need to be participating. What am I doing? That is where I think the fixed income presents different challenges in the aspect of just a buy and hold strategy saying, okay, I can do this. Now, I know people that have we have clients that have very large portions in fixed income. And some of them don't care where rates go. And what I mean by that is rates can go up, rates can go down, but they know they have locked in, especially if they're in like munis. Say, look, I know I'm going to get this for the next 25 years, 30 years, whatever it may be. I'm good with it. Now, that's not most people. Most people are probably, more inclined if rates are going up. They want to get out of those and get into something higher. But there's always the cost of doing so. And that's the problem, because even what you have, your premium or your net asset value is going to be going up and down, trading at either a premium or a discount. And so the bond narrative is great in theory, but you're right, it won't keep up with inflation over time, even with that adjustment that you're making. Now, if you have that portion in equities and you can continue to move those funds over, buy more bonds, increase the income from it, yes, that's a great way to do it. Yeah. But I don't think many people are doing that. But then going back to the big picture, you just painted a picture of a 50-50 portfolio.
Right.
So,
because I need easy math this early.
No, I know, and that's great. That's good for everybody. But if you had a 50% decline and you did nothing, what would that portfolio be down, assuming bonds and cash remained stagnant?
Well, so I mean, if I have 50% of my portfolio in stocks and I lose 50% of that value, my portfolio will be down 25%.
Correct.
Yeah.
So if you're also proactive, so most of you guys know we're pretty proactive. We're very nimble when it comes to investing. And so most people come to us because they want somebody that can mitigate risk. It's not perfect. We cannot avert risk. We can't guarantee people are never going to lose money. That's just not the way this works. However, we can follow technicals, a discipline to reduce risk over time. And you talked about that earlier, that most of the time in most markets, barring some, Black Swan event, they're going to give you some type of lead here. They're going to give you a heads up. And so you're going to be able to reduce exposure into something like that. And so most of the time, if you are proactive and not just that buy and hold, your decline is typically not nearly as significant as the broad market.
Yep. No, it's true. And again, there's a lot of ways to mitigate that, kind of that overall market decline. And we talk about hedging, taking profits, rebalancing risk, raising cash, all those type of things can certainly help mitigate the decline during a more protracted bear market event, right? And even just earlier this year, we were talking about raising cash in March, late February, early March, because we knew a correction was. There were evidence signs that the markets were extremely overbought, extremely extended. You're going to have a correction, and so we had a correction, right? It's just no big deal. So you can navigate, and this is the big thing is that, I wrote about this I think in last weekend's newsletter, is that even if you're a passive investor, which is kind of a oxymoron because you really can't be an investor if you're passive. But even if you're a passive investor, it doesn't mean that you just have to let all this stuff just wash over you, that, that you're just going to kind of stand in front of a correction and just get hit by the train. And yes, there are people that do that, and that's okay. They just say, oh, I'm just going to keep investing and, just keep throwing money in the markets. And if you're in an accumulation phase, you can do that type of stuff. But the bigger risk than what we're talking about specifically is post-retirement, where you've got to make this money last for, 30 years or so. And the important thing for that is that you've got to apply some risk management. You've got to navigate these downturns in the market so that you don't spend, a couple of years trying to get back to even. You've got to keep that money growing over time to adjust for inflation, to adjust for the rise in medical costs, to adjust for not just the increase of just inflation in medical costs, just the use of your medical expenses are going to go up because you're getting older. So we've got to adjust for all these things. And that's where, back to Danny, this is where, the financial plan really becomes so very valuable, is to start factoring in, okay, I've got to make this much of a return every year, but I've also got to factor in that I'm going to be spending more on medical bills, more on this. So my rate of return really needs to be this. It can't be 4, right? It's got to be 5. or whatever it is. But you've got to start adjusting for these things to make sure the portfolio has survivability.
Yeah, and we see that on the opposite, and we talked about that just before the break a bit, that, there's also times clients say, hey, I've got 5 years to retirement. I really need to get aggressive. It's like, wait a second. Well, but when you look at that on a planning perspective, you factor in that higher standard deviation, so more volatility, that actually your probability of success typically declines. So unless you are just a super saver and you're putting away a ton of funds, if you're kind of keeping a status quo, what you've been doing, if we're looking at them apples to apples, there's a lot of times that adding that additional exposure actually reduces your probability. And so that is something that I think is kind of eye-opening to many people. Like, that doesn't make any sense. Well, it does, because if you do get one of those events and it is much worse, you don't have the time to recoup from it. So when we are in retirement, we do have to think about, and you just talked about it, you've got to employ some type of risk management. And it's not perfect. It doesn't mean you don't go down, but it also means you participate. And so you're going down, typically not as much as the broad market, but you're still participating on the upside, because all these narratives, all the things that we hear about over and over and over again, they're just that, they're narratives. And many of them never come to fruition. And yes, someday one of these will. And there's been plenty of people who've been on air for 10, 15 years talking about the same narrative, once again. And someday they'll be right, and that's what most people will remember them for. But we can't let that sway every decision that we make.
Yeah. There's good question in chat is that, is 60-40 a good allocation for retirement? You're okay, building a portfolio, and this is strictly from portfolio management perspectives, right? You're okay in retirement with 60-40, 70. You could even go 70-30 if you're a little bit more aggressive and you're willing to pick up volatility. You can do 70-30 in retirement. 60-40 is the kind of the historical benchmark for kind of conservative retirement accounts, and that's a really good one. That will generate a good inflation adjustment over time, create income. You've got the dividends from both stocks as well as your income interest from bonds. And you're okay at 50-50. You start struggling at 40-60. You got 60% bonds, 40% stocks. That becomes more of a challenge to adjust for inflation over time. But once you get below 40-60, it becomes really difficult to adjust for inflation over time. And that's we have clients that are in like 20-80 models. They have 20% equity, 80% bonds. That's okay if you got enough money and you don't really have to account for inflation adjustment over time out of equities. You can do a 20-80 model and lock in the income. But if you're kind of borderline, I've got enough money to get through retirement, and you're kind of right at that edge of what that number needs to be, whether it's $1 million or $500,000 or $1.5 million, whatever, 20-80 makes it really difficult to adjust for that inflation run. So I would certainly encourage more of a 40-60, 50-50, 60-40 if you're kind of in that bracket.
Yeah, but also, what are the objectives? Are you looking to never dip into your principal? What's your legacy intent? Are you charitably inclined? There's so many other things that go into play when it comes to something like this that you need to be considering. So just looking at it from the outside looking in and saying, hey, can you do that? Absolutely. And 60-40 is the most common. You walk into any major institution, but like our 60-40 versus a
traditional is not the same thing.
It's way different.
Yeah, they're not the same thing. And I am not charitably inclined, or my kids are getting nothing. So I'm spending everything before I go.
Oh, whatever.
So
yeah, it doesn't really matter. You're
Danny
work
was
till
all
you're
excited.
dead.
Danny was going to be the trustee for the family trust, right? And he's going to have nothing to trust over. So,
hey, well, I don't really care. You're going to die at your desk. It's okay.
All right. Thanks for watching, guys. Be sure and subscribe to the channel. We are just shy of 33,000 subscribers. Give us a like. Give us a subscribe. We certainly appreciate it very much. And we'll see you back here tomorrow with Michael Leibowitz talk all about interest rates, Fed, bonds, more right here on tomorrow's show. Real Investment Show. Have a great day.